the government is about to start messing with your ISAs. Cash ISAs, stocks and shares ISAs, even the lifetime ISAs could all be hit in this month's budget. I've worked in finance for 15 years and I've seen lots of budgets come and go, but this one could reshape how millions of people save and invest in the UK, cutting the cash ISA allowance. So right now, you can put up to £20,000 a year into ISAs, and if you like, that can all go into cash. But one of the big ideas being floated about is to cut the cash ISA allowance to around £12,000, some say £10,000, or some even as low as £4,000, but whilst keeping the overall £20,000 limit. Now, the thinking is this: too many people are just sitting on cash and not enough for investing, and that's bad for the long-term growth of the UK economy, that's bad for UK companies trying to raise capital, and I think that's a fair assessment. We did an entire video on this very topic, just here, link will be at the end. As of January 2025 data, an estimated $526 billion was sitting in current accounts paying 1.5% interest or less. So whilst it is true to say that underinvesting in the UK is clearly a problem, it just seems this is the completely wrong solution. Instead of penalising for people for holding their money in cash, instead launch an effort to educate people on personal finance and promote investing. Doesn't that solve more of the problems? The whole carrot and stick vibe, this seems more carrot than stick. And the most frustrating thing is that there's some data about this already that it just won't work anyway. But take a look at this from MoneyWeek. Research polling of 1,400 cash ISA savers, 4/5 of whom were aged 65 or over, by Paragon Bank found that the majority would not invest in stocks and shares in light of a cut in ISA limits. They would switch to regular savings accounts instead, potentially driving up their income tax bill. So people are already saying that this change wouldn't even necessarily push them to investing. But that goes back to what I was saying a second ago. This is why education should lead the charge on this. Stocks and shares ISAs, UK equity allocations. So this is one of the more controversial ones. But according to recent reporting, the Treasury has spoken to city firms about requiring a minimum allocation of UK shares inside stocks and shares ISAs. Figures like 25% to 50% have been mentioned. Because does this mean that if you hold a global tracker fund like the FTSE All-World, where the UK typically makes up about 3 or 4% of that index, might you be forced to hold extra UK exposure to hit that minimum threshold? For a lot of investors who deliberately choose simple, global diversification, it's a really big change. And I really want to illustrate this with an actual example. Let's say you have £10,000 to invest in a stocks and shares ISA. Under today's rules, you might choose a simple global index fund, and let's just assume an average return of 10% per year. Now compare that with the UK returns. The FTSE 100 has returned about 5.2% a year, and the FTSE 250 has returned about 8.4% a year. Now, if you blend those two with a roughly 50-50 split, you're looking at around a 6.8% annual growth for a UK-focused mix. So what do these two options look like in 20 years? £10,000 in a global tracker at 10% gets you to about £74,748. But our 50-50 split would get you to around £56,780. So that's a difference of roughly £18,000 or about 24% lower portfolio value. So what are we saying? In other words, by forcing you to hold a big chunk of UK equities, the government would effectively be taking away a large part of the benefit that you would get from actually using an ISA in the first place. But this is the real kicker. Even if you held the higher returning global portfolio in a taxable general investment account, paid capital gains tax and used your annual capital gains tax allowance sensibly, you'd still likely come out ahead in many scenarios, even after paying the tax bill. So if the stated aim is to, quote, provide better returns for investors while boosting UK investment, these numbers just don't support that, allowing LTFAs in ISAs. Now, there are some more technical changes being discussed, which I do want to get into. The first of these is allowing long-term asset funds, or LTFAs, inside ISA wrappers. Now, let's do a bit of demystifying. An LTFA, as we've mentioned, is an investment vehicle which an investor can gain exposure to a long-term and illiquid group of assets. These are things like private equity, private debt, real estate, and infrastructure. But take a look at this. The government's decision to allow LTFAs in a stocks and shares ISA from April 2026 could transform access to private markets, but questions remain over liquidity, suitability, and platform readiness. More than 50% of the fund must be in unlisted securities or other long-term assets. That's where you get the whole illiquid part. So this would basically give normal, everyday retail investors a bigger and better exposure to a means of investing that most regular people are just completely shut out of at the moment, which on the face of it seems like a good thing. But there are some important caveats. The first one is that these are typically either high risk or long-term investments, neither of which are necessarily features of an investment or asset class that is liquid. Now, whilst you might be saving and investing for a long time horizon, one of the big advantages of an ISA over, say, a pension is that you can withdraw as much of your ISA as you like. They limit your annual contributions, but not your withdrawals. So it does feel as though there's a bit of a mismatch there between what they're actually offering and what the ISA offers. And of course, the other big risk is that these are risky and complicated investments, which, if we are being totally honest, most people are just not in a position to be able to reasonably assess their suitability and risk for. And I think this is proven by the fact that we have so few people in the UK who will invest in a global index fund. And we've already started to see this to some extent, and we covered it in this video that you will soon be able to buy crypto and put it into your stocks and shares ISA. The British ISA. Ugh, this one is back again. So let's just very quickly recap. The idea originally came from Jeremy Hunt when he was Chancellor. Now the idea was simple. You could get an extra allowance if you only invested in UK assets. So you'd still have your £20,000 normal annual ISA allowance, but you could get an additional pot, originally proposed to be £5,000, that could go into UK listed investments. Now, on paper, this sounds like a pro-UK investing incentive, and it was sold to the public as exactly that. But the truth is, this idea was always going to be a bit of a dud. It was completely dead on arrival, which begs the question why Rachel Reeves has decided to revisit the idea, but never mind, more on that another time. The reality is it risks three things. It risks adding yet another product and more confusion to a system that is already full of different types of ISA. The second, it's not doing what it was aimed to do originally. Because of the complexity and how these products work, if you have a global index fund, which would include British assets, does that use up your £20,000 portion of your limit or the £5,000 portion of your limit? And third, this would be a nightmare for providers to administer. And at a time when the government is trying to encourage more people to invest, adding complexity just seems as daft as you could imagine. And there is a much more basic problem which we should really go through. And this is a problem for both the British ISA and the minimum British allocation we mentioned earlier on in the video, which is what counts as a UK investment. So let's dive into this a bit. The main problem is that in the FTSE 100, around 82% of revenue for FTSE 100 companies come from outside of the UK. So how do you define a British company? So unless they can qualify what that would be, it's already off to a bad start. Simply forcing more people into UK listed stocks is a really kind of blunt instrument that doesn't achieve the goal that they say they want to achieve. Most people using ISAs just want simple, global, low-cost index funds, not to become stock pickers of UK small-cap shares. It's just a complete mismatch between what they want the policy to achieve and what it would actually achieve. And my view personally is it feels a little bit like they're trying to get the UK taxpayer to invest in the things that the government should be investing in. Next up, stamp duty changes. Finally, one rumour that investors may actually welcome. There have basically been calls and reported conversations with the Treasury to remove the 0.5% stamp duty on UK share purchases inside ISAs. I know it's confusing. We have two things that are called stamp duty for totally different things, but imagine that, the UK tax system being completely and unnecessarily complicated. Who would have thought? Now, that would make investing in UK shares slightly cheaper and could nudge more people towards the domestic market, but it also blows a hole of between £4 and £5 billion a year in tax revenue, which, for a government that is scraping the absolute bottom of the barrel for its latest fiscal black hole, just seems kind of unlikely. Really, at a time when they're scrimping and saving every single bean they can get their hands on, this doesn't seem like it's going to get the green light. I just really cannot see this one happening. ISA limits. This is potentially the worst one of the lot, and I'm glad to see that there hasn't been too much chatter about this one. But first, let's wind the clocks back. In January 2023, there was this report from the Resolution Foundation, ISA Baby. And one of the proposals that came out of this report was to cap the overall value that an individual can hold in a single ISA of up to £100,000. So basically, your £20,000 annual limit would remain. And we've sort of talked about how only about 7% of people who even have ISAs hit that annual limit every single year, but it would basically mean you can't save more than £100,000 in your ISA. Now, this is a terrible idea, Not for the reasons you might imagine. Yes, only the wealthiest people can afford to maximise their ISA allowances every single year. That is true. But at the same time, it feels like it would send a message to discourage people from putting money into an ISA and for saving for their retirement, something that successive governments have been trying to encourage people to do privately because the cost of the state pension is absolutely ballooning. And you know what? People would be right to worry. With frozen income tax thresholds putting more and more people into higher tax bands, people might quite rightly assume the same thing. Okay, fine, it's £100,000 now. Maybe next year it'll be £80,000, maybe the year after that it'll be £50,000. And whilst I personally don't love the whole slippery slope argument, I feel like it's used a lot, especially in circumstances where it doesn't really apply, but here I do think it does apply. The system is already too complicated. The whole ISA system is a great idea, but it doesn't need more moving parts. It needs simplification and education, not more tinkering around the edges here and there. Because let's face it, right now we already have the cash ISA, the stocks and shares ISA, the lifetime ISA, the junior ISA, the innovative finance ISA, and now we're talking about adding things like a British ISA on top of that, potentially tweaking the rules inside existing ISAs, maybe adding LTFAs, maybe cutting one allowance and boosting another. And if you're a policymaker, it might feel clever and targeted, but if you're just a normal, regular, run-of-the-mill person trying to save for a house deposit, trying to put money aside for your retirement, it just feels like there are more and more and more layers of rules that you have to navigate. And just to give you an idea, I get asked so often by people who assume that the total ISA limit is £20,000, not that it's an annual limit that resets every year. If most people can't even get that right, then what chance they have of investing in private equity markets? We should also point out crucially that none of this, absolutely none of this, really fixes the underlying problems. In my view, the government should use ISAs as a simple, trusted wrapper and pair that with better financial education. So what should you do now? We should point out that for now, all of this is rumour and speculation. Nothing has been passed into law and nothing has been formally announced. That will happen at the end of the month. So my personal view is this. Keep using your ISA allowance and stay diversified. Don't let political branding override basic common sense investing principles. Keeping your investing costs low, diversification always being a good idea, and keeping an eye on your investing time horizon. If and when specific changes are announced, I'll break them down and run the numbers again so you can see what this will actually mean for your money. We have 3 videos on screen. We have the 9 best investing tips from ISA millionaires. We have simple ideas that will change the way you think about money. And we have how you can now invest in crypto in your ISA. Thanks for watching Modern Money Talk. If you've liked this video, please like and subscribe. Thanks very much for watching.